Hey everyone, welcome back to Lutamarkets. Today we're diving into a fascinating topic in the world of trading, the inversion liquidity gap. If you've been following my channel, you know I love breaking down complex concepts into simple, actionable insights. So let's get started. First things first, let's talk about what an inversion liquidity gap actually is. In trading, a liquidity gap is a price area where there's a significant amount of buy or sell orders waiting to be filled. These gaps often occur after a sharp price movement, leaving a hole on the chart where the price didn't trade. An inversion liquidity gap takes this a step further. It happens when a normal gap forms, but then the price reverses to fill that gap, and in the process, breaks the existing market structure. This reversal and structure break are key characteristics that set it apart from a regular gap. Think of it like this. The market creates a gap due to a sudden move, but instead of continuing in that direction, the price swings back, swallows that gap, and shatters the previous trend or support or resistance levels. It's a powerful signal because it shows a shift in momentum and often traps traders who were betting on the initial move. Now let's break down how this setup comes to life. It all starts with a normal gap. This happens when the price jumps or drops quickly, maybe due to news, economic data, or heavy institutional activity, leaving an unfilled area on the chart. You can see this in the chart I shared, where the price made a sharp move downward, creating that initial gap. But here's where it gets interesting. Instead of the price continuing in that direction, it reverses. This reversal is the inversion part. The price moves back to fill that gap, pulling liquidity from those trapped orders. And as it does this, it also breaks the market structure. Think of breaking a key support or resistance level. This break is a critical confirmation that the market is shifting. The setup gets even more confirmed when the price retraces to the equilibrium of the gap. In my chart, you can see this equilibrium line where the price stabilizes after the reversal. This retracement acts like a magnet, drawing the price back to test that level, and if it holds, it's a strong sign that the inversion liquidity gap is in play. So why should you care about this? Well, an inversion liquidity gap is a high probability setup. It's like the market is screaming, "Pay attention." The reversal and structure break often catch traders off guard, and the retracement to the equilibrium gives you a clear entry point. It's another confirmation setup, especially if the price breaks the structure and then respects that equilibrium level. This can be a goldmine for swing traders or those looking to ride a trend reversal. Let's talk about how you can spot this on your own charts. First, look for a sharp price move that leaves a gap, up or down, it doesn't matter. Then watch for the reversal that fills that gap. The key is the structure break. Did the price smash through a previous high or low? Finally, keep an eye on that retracement to the equilibrium. If the price bounces or holds there, you've got yourself an inversion liquidity gap setup. In the chart I showed you, you can see this play out perfectly. The initial gap formed with that downward move, the price reversed to fill it, broke the structure, and then retraced to the equilibrium line. It's a textbook example. Now let's get into how you can trade this. One approach is to wait for the structure break and enter on the retracement to the equilibrium. Place your stop loss below the low of the gap if you're going long, or above the high if you're short. Your target could be the next significant level or a measured move based on the gap size. Another strategy is to use this as a confirmation for a larger trend. If the price breaks the structure and holds the equilibrium, it might signal the start of a new trend. Combine this with other indicators like RSI or moving averages to filter your entries. Before we wrap up, let's talk about some pitfalls. One mistake is jumping in too early. Don't enter until you see the structure break and the retracement. Another is ignoring the context. Is this gap part of a bigger trend or just noise? Always check the higher time frames to confirm. And finally, manage your risk. These setups can be powerful, but they're not foolproof. So use proper position sizing. The inversion liquidity gap is a fantastic tool in your trading arsenal. It combines the psychology of market reversals with technical structure breaks, giving you a clear edge. Next time you're analyzing your charts, look for those gaps, watch for the reversal, and wait for that equilibrium retracement. It could be the setup that takes your trading to the next level. That's all for today's deep dive on Lutamarkets. If you found this helpful, smash that like button, subscribe, and hit the bell icon so you don't miss our next video. Drop your thoughts or questions in the comments. I'd love to hear from you. Until next time, happy trading, and I'll see you in the markets.